Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, July 14th, 2022. Just want to do a quick update on the equity markets, commodities, and the whole inflation thing that I've been talking about lately. So, won't be super long video. A lot of this is things I've already gotten out to you in bits and pieces, including at least one of the charts today. But we're going to start out here with equity markets. Nothing's changed. We still have the makings of a near-term uptrend in QQQ, another pullback right to yesterday's levels. Told you I bought that dip yesterday, lightened up, of course, after the bounce on those shares, and then recycled back in because we came right back to the same level and to the trend line. So this continues to be one level to watch, not the be-all end-all, but certainly a level. This is our near-term uptrend line. There's a great example of trading. On the time frame that you're trading off of. In other words, this is a 60-minute chart, hourly candles, and you can see you had an intra-period dip only to recover and close that second 60-minute candle of the day right back on the trend line. If you zoom in, you can take the trend line and tighten it up a little. Sometimes you zoom in real tight and you can see you want to come in, capture the bottom of the bodies. I like to get the most number of bodies and or shadows. The shadows the skinny part, and so quite often it's usually the bodies that'll produce the reaction lows, but sometimes you'll have some shadows there as well. So far, it's holding trendline support. Dip buyers are stepping in, buying the dip. So if you look at it, micro trends, very near term, the trend is certainly bearish. We've been walking lower. That could continue. Obviously this is a big level down here, big support, and of course nothing's probably more important than the previous reaction lows, but you had quite a bit here. You had a big gap right there that made this, I'm still going off this theory that was a bear trap, false breakdown. It was big support back here that goes to the left of the chart. We gapped above it, back tested it on numerous occasions and held. So maybe we see that, maybe it gets taken out, maybe not, and we'll see. There's plenty of other things to trade, but let's talk a little bit about the inflation trade. Before I get off this chart, one thing to note too is a trend indicator. You have a level here. There's two lines on the PPO. You can use the PPO. I like to use the signal line as a trend indicator. The signal line is the 9 EMA. It's the white line. It's the last of the two to cross. And here we can just turn off the PPO line or turn it down and make it go away there, and you can see that then it makes the zero line go away. I'm going to put it back, guys. Hold on one second. Let me just put that back, and you can see the white and the blue line. So the dash line is a zero line, and that often acts as a very good trend indicator. And again, focus on, so the white dashed horizontal line is the zero line on the PPO. When you cross above it, that's a bullish crossover of the zero line. When you cross below it, it's a bearish crossover. Now you also have bullish and bearish crossovers of the PPO lines themselves. Like there's a bullish crossover, there's a bearish crossover. Those act as good signals. But then you have, that's the zero line, and you can see when the white line is above, the trend is usually bullish, and when the white line or the signal line is below, which I'm circling here the whole time, you're in a bearish trend, and it does a great job quite often of acting as support and resistance. So in other words, in a downtrend like this, on a kickback to the zero line, often you get rejected, keeps the trend bearish until you make a bullet. Now that was a whipsaw given, but then you had a crossover there, and that one proved to be good, and it was a nice tradable rally to be made, and it came early on in the rally too. And then boom, it said boom, back bearish there, cross below, put us in a bearish trend, and then boom, gave us a bullish cross. So a little bit whippy, I will say that, and it's not the be all end all, but I also have a line here at about the 0.77 level that also does a good job, again, at different periods in time, and we did cross above that here, and we back tested it there, and we remain above. So I just want to throw that out there. It's again, not the most reliable trend indicator, but some of the bigger trends, when you're above it, either of those two lines, it can keep you in that trend. And then also when you back test it, that's something to look for. So we have a makings of a near-term uptrend since we crossed right here. We successfully back tested the level right there, and we're coming up on it now. So if we can hold this trend line and or that level, the 277-ish, 276 level below, and then rally from there, that may keep that trend indicator bullish. So we'll see what happens. Let's talk about today. Okay, today that's I'm on the stock market, and then I'll get to the next thing. Something kind of new I want to talk to you about. J.P. Morgan, that was the big news. That's what knocked the futures down this morning. This is the 800-pound gorilla in the financial sector. It's the largest. And they reported a loss because they had set aside additional capital for loss reserves. Everybody looks at J.P. Morgan and the big banks because they have insight to the consumer. They see, as far as your privacy goes, you're all, just about everybody listening to my voice has a lot of their money at the bank. And they see everything. They see direct deposits, payroll. They see, savings accounts, money markets, things building up, ebbs and flows, defaults early on. See when defaults on credit cards and or late payments, things like that, car loans, everything. So I don't have to tell you the importance. But now, as I told you the other day, we had at J.P. Morgan. I said this is a great level. So I almost threw it out as a trade idea. It is a trade idea if you want it right now. And you might say, Randy, wow, man, this is just missed estimates by a wide shot. But look, you have positive divergence. The stock is already down, which it was called down to this level from a long time ago. I had these targets here. That is big support. It was this triangle pattern here, that ascending triangle pattern that was back in 2020, and with a gap away, a breakout gap. And we're there. We have positive divergence. So you can buy J.P. Morgan with positive divergence at support. Now, here's the thing. You might be saying, no, this is a bear market. We're going lower. These are the trades. If you just want to, if you're having a tough time struggling with the trading, be mechanical. Take a shot. You're taking a shot on an oversold stock at support, good support with positive divergence right around the 105 level. If it bounces from here, which I suspect it will, it's at minimum, I think it's going up that 119.42 level. That's about 14%. So you say, okay, I'm shooting for a 14% return. I can allow myself, let's say, a 4% stop loss. That's better than a 3-to-1 risk reward ratio. 4% drop would be somewhere down here around 101. And that's it. Set it and forget it. Use OCO orders. I'm a big proponent of those, especially if you find yourself a little lacking in discipline in your trades. OCO orders says you set 2 orders. Some brokers call them OCA. If you don't know what they're about, call your broker. Just go onto their website and look. And it's one cancels the other. So you have a stop loss there, what I just said there, and your price target there. There could certainly be more, and that's it. So, and look, here's the thing too. Sometimes if I take a shot at a well-defined support level, I'll even use a tighter stop. You could have a 5 or 6-to-1 risk reward ratio. You could put a stop pretty much below, maybe a little bit below today's lows. Give it a little room. There's the support around 105. You could give yourself a very small stop, but I think, like I said, about 4% probably works. If you want to be safe, wait till a daily closing basis in case they want to run the last of the stops before running it up. That often happens intraday, and then there's a reversal. Up to you. The downside to allowing an end-of-day stop is that the stock could continue to fall, and then it exceeds your 4% by a wide margin. And there it is on the weekly chart. You can see this is big support here for J.P. Morgan. It was big support back here in was resistance in late 2017. We broke out, or the stock broke out, back tested it for months. These are years down here, 2018, 2019, and you can see it was support, brief breakdown, whipsaw, regained it, and it acted as support again. There was COVID. Once it broke it, melted down, tried to rally back, got rejected. 2 weeks, 1 week tried to get above. The following week it closed back down. So that was a whipsaw. There's these things aren't perfect, and if you get whipped out, you can always get back in. In other words, if you took that breakout, well, when it failed you, that's where you should have got out. And then resistance, breakaway gap, and that gap has now just been backfilled. So that's it. Stocks at oversold levels. Last time you bought at oversold levels, if you did, was when COVID hit, and it was down 46%. Time before that we were at the oversold reading on the RSI was all the way back in 2011, and if you bought it, you did pretty darn well. It went up 500% from there. And then the time before that was the last bear market in 2009. If you bought it there, obviously you did well again. So that's it, guys. Just mechanical. Yeah, we're in a bear market. Is it going low over time? Yeah, I think so. I think this is, it's not going to be yesteryear's bear market. I think this one's going to be, and I've said that many times, a lot different. And so somebody asked in one of the comment sections the other day, I gave my thoughts. I just cautioned to using analogs to previous bear markets because this time is different. They're all different to an extent or another, but I think the question was had to do with inflation in the 70s, the Carter administration. That what we're seeing now, everything the Federal Reserve has done, not just in COVID, even going back to 2008, is unprecedented. We've seen unprecedented disconnects where the whole stock and bond inverse correlation thing stopped working because of such heavy manipulation into the bond markets by the Fed, and heavy manipulation, excessive manipulation with artificially low interest rates for too long. So I caution anyone trying to overlay, and a lot of people throw those out. They're easy to do, and I even did it towards the top, if you recall, and that worked well. So, but then I told you I was going to get away from that, and I was talking about the stock market, calling it down off the top. It worked very well with some of those early on, the analogs from the previous bear markets that I showed you back then. All right, that's it. So look, and there's a little more downside there if you look at it on the weekly chart. So really the support's about 104. Again, take it, don't take it. And let me show you one other thing here. Oh yeah, XLF, of course, the sector. Always look at the sector if you're going to buy, especially a market-leading stock, and this is it. So you had a major reaction low back here from 2018, a major reaction high, I'm sorry, and that should really be a support zone because that was a major reaction high. So I'm going to put the line there again, the 2018 high. You broke above it, and you had negative divergence. Remember, COVID itself was a black swan, but it was priced in a lot of sectors and stocks, and the markets had negative divergence. And there was your trend line breaks. That was just a big old bearish pattern there. And COVID just made everything, that bear market, play out super fast. And then it was over. And then you set up a similar big negative divergence at the high here, and you came down. And so that's it. So let's not overthink it. Financials have fallen to support. Everybody, where I was an ardent bear, unwaveringly calling these, these downside targets back here, the majority of the masses didn't see a bear market coming. And now that's all they're talking about. How much more? The bear's got a lot more to go. Recession, blah, blah, blah. Financials have fallen 27%. All right. So, and a lot of sectors and everything else have fallen quite a bit. And again, I think we've started a much larger prolonged bear market, something more akin to Japan with their lost decade. If you study that, go back in the 80s, 90s, look at what the Nikkei did. So I do think over time financials go lower, but I think there's still a decent shot of a big rally here. And let's talk on that. Let me put that divergence line back there. Okay, so I got this chart out to you today along with one of the trade ideas. DJP. This is again, I've said this many times, one of the most diversified commodity indexes. There's a lot out there, a lot of and it's just an ETF that tracks the index. So it's going to do an almost perfect job. There's others out there, but some of the other ones that I have in my commodities watch list, the commodity broad diversified ETNs or ETFs, are too top heavy in crude and natural gas. This one has a more balanced weighting, and so you can see what's happened here in just the last month. So this we're on a weekly chart. It's probably where we're going. And again, you've heard me say this the last few days. I think it's our little secret here because I'm not hearing this anywhere else. Again, I don't immerse myself. I hardly ever turn on the TV. I'll get my news from the headlines that come in from various sources. But all they're talking about right now is the hottest inflation print in over 40 years. That's the headline. Fed funds futures shot up to an almost certain, not certain, but a 75% chance of a 1% increase in the federal funds rate. And the one guarantee I've always given you about the Fed is they're always behind the curve. So where I'm going with this is what I'm showing you, and again, if there are other things in the CPI, it's not all commodities, but this has food and energy, And again, not food prices at the store. I do know there's a difference there. I talked on that yesterday. Traders, or I'm sorry, the CPI isn't measuring, futures. They're measuring the, end product of the consumer. But again, that follows. When prices drop, ultimately, that will permeate into the much lagged and dated CPI. And so this is the closest thing we have to a real-time CPI or consumer price index. This coupled with real estate. Let me show you a chart that I made today. Hold on one second here. Okay, one of the big things lacking in my real-time inflation indicator obviously is shelter. Shelter is one of the biggest components of the CPI. And that one is more lagged. There's no real-time data. It's just like, the stock market, commodity, you can tell on any given day exactly what corn is selling for, or a barrel of oil to the second. Those are publicly traded commodities or securities. Home prices have always been a tough one because nobody knows to minute by minute. Zillow will give you the updates on the estimate of your home, and if you follow that can be greatly skewed, and then it gets reset when your home is bought or sold or another one around you. But anywho, is what I'm showing you here is this is one metric. I did the unadjusted, non-adjusted all homes index, and you can see for the first time, this is 5 years. This was what you're looking at is a persistent uptrend. It was headed up, never once turned down, and this is where inflation, thank you Powell and Washington for all the excessive stimulus, and that's what sparked inflation. But where I'm going, for the first time, we haven't turned down, but this line, the slope of the line has turned down. The line is leveling out. And again, maybe it's just a blip, but I suspect with what's happened, interest rates up and the stock market down, that's going to cool the housing market. So this is a trend to watch. And all I'm trying to show you here is it's a trend that has finally, for the first time, this is 5 years of history, had some abatement here. Look at California turning down. The first time again in 5 years we've seen this line turn down. Florida, you can enter New York. Some of those others are leveling out as well. And again, just one thing to watch here. Now, where am I going? I keep talking about this over and over the last few days. Fewer things in the stock market, really in the world, are more powerful than a paradigm shift. And so all I'm saying, guys, believe me, I'll flip over if we roll down, take out the lows. I'm gonna take some losses on the longs I pivoted into recently. And I also active trade. I have swing longs. Those IRAs, I haven't moved those. Active trading account, in and out, long and short, almost on any given day. But that's just the trading account. But the other accounts, I'm still holding the longs for now. And so what a paradigm shift will be is if I am right, and this trend continues. DJP has more downside to go, assuming that, then this will be reflected. And then we have the potential, JP Morgan, they set aside, their earnings are down because they set aside a lot of money for lost loan reserves. But let's just say that things aren't as bad. You know what's the problem with everybody talking about recession right now? And again, I've showed you in Google Trends the biggest surge in that search term ever, and they put it relative. They don't put it hits back in 2008 total hits. They adjust it, over time. Anywho, so the point is, if all of a sudden there's a shift there, and all of a sudden, let's just say the Fed goes ahead and gives us the 1%, which is the probability right now that about a 3/4 or 2, as of yesterday, 75% chance. And then all of a sudden it has to backpedal because they're seeing home prices start to come down, and and this again gets reflected. This big drop here, you're looking at it, and this is 4 or 5 weeks of nothing but plummeting commodity prices, and then sooner or later that's going to be reflected in the CPI, and then they're going to realize they overshot. And so if they have, whether it's at this next meeting or 3 meetings down the road, or the street starts to realize that, hey, these rate hikes, this is where I'm going, guys. The rate hikes are working. And sometimes the Fed's biggest tool for years has been jawboning. It's more of rhetoric than action. You know, they'll talk about lowering rates or talk about raising rates instead of actually doing it, because they've used up most of the arrows in their quiver, really since 2008. And so right now, you know, just the fear of a 1% hike has scared a lot of people out of the market. Another 1%. But now let's talk about, okay, what I'm doing here is kind of, again, pivot into where I was 6 months ago, you know, as we headed into the year, and I was at, you know, unwaveringly bearish short. Every bounce back into resistance that we had, I highlighted that as objective short entry. We shorted here, we shorted that breakdown, we shorted this breakdown here, we shorted bounce backs. Every one of these 200-day moving averages, those were highlighted, even down here. And so at this point in time, again, how much more do we have to go before we have a decent bear market rally? And again, paradigm shift. Think about that. If all of a sudden it becomes pretty clear that the sky is not falling, in other words, the consumer's hanging in there, JP Morgan's got all this cash set aside for loan loss reserves that maybe they don't need. Maybe they put too much away. Maybe the consumer's in better shape. And so let's talk about one other thing that has to do with all of this. This is how my mind works. It's multifaceted. So the economy, that is, the financial markets. So a while back, you know, back here I was saying bonds were one of the worst investments, and it was the worst point in the history at least of my lifetime, if not the entire financial markets, because there was nowhere but up for rates to go. And that's what happened. So they took it to the ground when COVID hit. TYX, I'm sorry guys, I'm talking fast. This is the 30-year Treasury bond yield, not bond prices. Bond prices and yields move indirectly, inversely. And so we went up. And then when we got about here, although I remain long-term bearish on bonds and bullish on rates, I think we're going to enter a new cycle. As what I was telling you back before we got here, this is the trend line. This is Carter right here. Hyperinflation in the 70s. This is Reagan coming in, and we started at that point in time. That's where interest rates peaked. We had double-digit returns. We had 15% mortgage rates, 15% Treasury bond rates. Insane inflation. That's the numbers being cited now. The only analog that we have with inflation now goes back into this period here. So that's what they keep talking about, the highest inflation number in 41 years yesterday. Now, what happened is it ended, and we entered a new secular bear market in interest rates. And then they were naturally falling over time. And these are these blips down here are the excessive intervention from the Fed. This is when quantitative easing started right here, this first one. You can see we had a nice channel going down there, right? This was the natural, if you will, bear with me, natural market forces of interest rates. But then the Fed came in and kept messing around with quantitative easing, bond purchases, and artificially taking rates down well below what they were. And the pendulum swung too far, and you get, as you always do, a mean reversion. And yeah, you could use that word mean as a pun because it was mean to bondholders, but it was a mean reversion back to the mean. Took us right up to the trend line. So fast forward, bear with me. So right here I said, look, okay, we ran into, we're not going to go from here to here. I've never seen this happen. Go get this overbought, overextended with negative divergence and just blast on through that channel. I think over time, yeah, I believe we've begun a new, very, very early new secular bull market in rates, meaning higher rates. Bonds will probably be the shittiest investment for the next 10, 20 years is my guess, as a hold. There's going to be trading opportunities, and we'll break out. But here's the thing. We came here, and I expected, and we got it an abatement, or at least completely stopped. Rates stopped going up, and I said that would happen technically for this reason, running into resistance while being overbought with negative divergence. And I said fundamentally, everyone was buying bonds because the Fed was raising rates and talking about raising rates. And my goodness, bond buyers are usually institutions, which are supposed to be the smart money. They don't realize the Fed controls the federal funds rate, the overnight rate that banks can borrow from directly from the Fed. And so it's the shortest of short-term rates there is. They can manipulate they can try to a very large extent and sometimes be successful to manipulate the treasury bond market, but they don't set treasury bond rates. Those are set by market forces. And so, um, what I said would happen here, and this is what's happened recently, you'd see long-term rates start to come down when all at first they were just focused on the Fed raising rates and rates going higher, and then they realized, oh, well, okay, so short-term rates can come up, which they have because that's what the Fed controls, but that's going to bring down long-term rates because it's going to bring down economic growth expectations and inflation expectations. Sooner or later, the Fed's not going to quit until inflation abates, until everyone's convinced, all right? Not forget about my real-time indicator. The masses need to be convinced. They need to see the CPI start to reflect it. All right, but it comes down, and this would actually help the economy. It would help the housing market and help the consumer because falling rates, or at least stabilizing rates, they're still relatively low by historic standards. You look where the 30-year bond is, it's trading where it was back in, this is 2018, 2019, here's 2015, here's 2012. So we're just back to a normal period there in rates. All right, that's where we've been going all the way back to '08 right here. That's 2008, 2011. You can see the years down here. And then actually a lot of times, although you're buying a 30-year mortgage usually on your house, the 10 years often I've heard tracks is better reflective of the 30-year mortgage rate. And you can see the same thing. We overshot the channel. There was my downtrend line. Oh, you got to go all the way to the monthly chart. There it is. There's the monthly downtrend line. There's the price channel, and that's it. So we came up, overshot the channel by a hair. That's normal. I even talked about it before it happened. It's called a momentum fueled overshoot. But then you also had very good resistance, and that's what's capped rates. So here it is. I think long-term rates for the time being have seen their peak and could even come down. And they would go down with diminishing expectations for economic growth and inflation, which the two usually go hand in hand. Unless you have stagflation, which is the ugly monster where you have a stagnant economy or a recession, but you persist in inflation. But so that's it. So this what I'm getting at is this is good for the consumer because it'll help support and prevent an outright crash in the housing market. In other words, it helps support a soft landing case. Who would have ever thought I would have been in that camp? So anyway, want to point that out. So that's it. And again, the important thing now, guys, the whole thing about investing and trading the financial markets is trying to get in front of the herd, in front of the masses. So I can't guarantee this happens. Maybe the market just craps out and goes down now and falls and hits my next targets, and who knows, maybe it goes down through my long-term targets. But just listen and watch for the clues going forward. And if you start to get that paradigm shift where all of a sudden people realize, wow, we already had a heck of a correction, the economy is actually holding up, holy moly, the Fed may have just engineered that soft landing, because just about everybody's written that off, the whole soft landing theory, everyone I've listened to. And if there is even a hint, especially an increasing belief that may be the case, even if it's fleeting, and that's all I'm looking at, just fleeting, you could see a rush back into equities like you wouldn't believe. So don't underestimate it. So yeah, don't chalk me up as being uber bullish, because I'm flexible. I'll throw that away. I'm just telling you that's one, I think, quite likely scenario right now, and one that I'm going off of. And so I'm going to give swing positions and trend positions a little room here on the NASDAQ 100. Remember, earnings season, so it's going to be volatile until at least the fangs are out of the way at the end of the month here. But look, so far, just like yesterday, here's what's happened. You've got, and this is what happens in volatility high. You have people that spook easy. These are the folks that spooked and sold, got stopped out, or shorted into the hot CPI number, and then it got all bought up and then some. This is JP Morgan today, boom. But guess what? The buyers stepped in at the same level, and right now they're buying it up. All right? So we'll see. Now, bigger picture, these are battles, and the war, at least in the near term, is going to be this level right here. Got to get above these highs. So right now, if you strip everything away from a technical perspective, here's what you're looking at. You've got the uptrend line I gave you, and you've got what I think is big support there, around 298 or so, and that is an ascending triangle pattern. So if we can pop the top, great. Pop the bottom, well, not great, obviously, especially if you take out the support below. But we'll take it one day at a time and continue to watch what commodities do. Speaking of that, one of the big ones too for the housing market is lumber. And I've been watching lumber, and it finally broke down, had a trend line. It was in a little rally. Here's lumber futures right here, LB. And look at this. You had this is a hourly chart. You had a divergent low right there, a little breakout, rallied up. And this was our primary uptrend line. You put in this little divergent high there, at least on the RSI. So lumber just broke down today. Maybe it wants to go on a back test. But if it looks like it's probably going to move down here, and this is, by the way, okay, so here's, again, this is July 7th, so this is this month. So lumber was rising in June. Obviously, that didn't help the CPI. It doesn't help the housing market, but since early July, I'm going to measure it out for you, into today, we now seen lumber fall, that is 14.5% so far. And so again, this is further abatement of inflationary pressures right here. All right, I promised it wouldn't be a super long video. We're right at 31-minute mark. I'm going to wrap it up here and get it out to you guys. This has been Randy Finney with Right Side of the Chart. Have a great day.